Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the MarketSite studio, we have Mark Marex, Senior Director of Index Research and Development with Nasdaq Investment Intelligence, Carrie Freeburg, Senior Vice President of Product and Marketing at SILAC Insurance Company, as well as Alfred Eskandar, co-founder, President, and Chief Operating Officer of SALT Financial. They join me to discuss active versus passive investing trends, rethinking the 60/40 portfolio and trends in index innovation. It is great to have all of you with us at MarketSite. Welcome to Trade Talks. Let's go around the horn here, Mark. I want to kick it off with you. Let's talk about this industry theme, the transition from active to passive investing. Are you seeing that continue?
Thanks, Jill, for having me. Great to be here. And absolutely, the trend is really, really strong. We've seen passive ETF assets just in the last 5 years go from just under 5 trillion to about 11.5 trillion to end 2023. So growing about 20% a year pretty consistently. We had inflows of 870 billion in 2023 into ETFs globally, right? So at this point, active is being eclipsed by passive in total AUM. What you see is just, especially when the market has a tough year, hundreds of billions of outflows from mutual funds. I think investors are realizing that the value proposition of mutual funds and active management is just not what it used to be. Not when you have this many options for really great passively managed products.
And Carrie, from SILAC's perspective, what are you seeing in terms of trends with active to passive?
Yeah, I mean, most of our accumulation strategies with an insurance company is really focused on passive, and we've seen it really, consumers really gravitating to these products. So, I mean, I think a key question is thinking about the drag on performance that you can get with actively managed investment solutions. And a legitimate question is that drag worth it? Are we really seeing performance outpace the costs of that? When you think about index life products, indexed annuities that have these passive indexes built into them, oh my gosh, back in 2005, 2010, everything was going into the S&P 500, a little bit going into Dow, a little bit going into Nasdaq, a little bit going into Russell. Today we wake up in 24, we have over 180 indexes in our space at the end of the day. And these indexes are robust and get into lots of different parts of the market. You have S&P-like indexes to indexes with commodities. They include AI. We have disruptive innovators. We have international. I mean, they're all across the board, so people can really tailor their accumulation solutions to what they're interested in and different segments of the market that are exciting to them. For us at SILAC, we currently have $10 billion of in-force account values. 8 of that 10 is allocated to indexing. So it's absolutely, absolutely resonating with consumers.
Yeah, and to Carrie's point, Alfred, I mean, the growth has been remarkable. What are your thoughts in terms of the trends that you're seeing in the active versus passive environment?
Yeah, I mean, this trend really started over 20 years ago, and it's just been accelerating, certainly for the last 5. So when you think about product innovation, the mutual fund was a product innovation, and when you think about pooled investments. And then the index was, which was introduced by John Bogle earlier in the early 70s, was another innovation. And what you're seeing is an appetite for investors to want to have the most innovative wrapper or product that meets specific needs. And to Carrie's point about fee drag and overall just cost of the product, I mean, the ETF has literally just changed the investment management game, and it continues to evolve. So the trend of asset accumulation is certainly accelerating, and so is the different types and features of products that are leveraging indices to deliver investment strategy and exposure to investors.
It seems like, to your point, the product wrapper is making it more accessible to not only advisors, but to investors as well. I mean, that certainly is a catalyst in my mind.
Mm-hmm. Oh yeah, I mean, the distribution game has completely changed too. So if you think about the investors who are active in the market, this year versus a decade ago, a decade before that, more and more households are participating in, whether it's via their 401k or an online investment account, so on and so forth. So it's not just a product, but it's also the distribution that has been evolving, which is helping to push this trend.
Yeah, and Mark, let's talk about the growth of the Nasdaq index business. What's our role there in terms of being a global benchmark? Take the curtain back a little bit and tell us about that.
Yeah, sure. So I mean, we've done really well over the past 5 years as well in terms of growing our assets. End of 2018, we had about 160 billion in AUM across exchange-traded products tracking our indexes, very little in the insurance space. We've tripled that in 5 years, so grown a little bit faster than the overall global sort of passive AUM space. We're up to about 470 billion in exchange-traded products tracking Nasdaq indexes. That includes around 240 billion just in the Qs tracking the Nasdaq 100. I think people, maybe used to think of the Nasdaq Composite as the benchmark for many years, but it's really the Nasdaq 100 that has defined our business over the past, call it decade and a half. It's the 5th largest ETF globally. It's the 2nd most liquid behind only SPY. And we've got over 100 unique products globally tracking either the Nasdaq 100 or some version of it that maybe has some downside protection built in or is optimized to deliver a specific outcome for investors that look at it as this kind of ideal base benchmark to build products around because the performance has been so great for so long. There's a lot of things you can do creatively in terms of spinning off different type of derivative custom indices around that, and we fully expect that to continue.
Speaking of offering downside protection on some of the products, I'm going to open up the debate with you, Carrie. Let's talk about the rethinking of the 60-40 portfolios. Of course, that narrative is out there that 60-40 is dead. Do you subscribe to that, or do you think there's more behind it than just a blanket statement?
I think there's more behind it for sure. I mean, for me, I don't really sweat if we're talking about 60-40, 70-30, 90-10. I feel like every year we rethink that. Every year we also hear different numbers about how much should you withdraw from your portfolio for your lifetime income. Should be 5, 4, 3, like that keeps changing. For me, I try to simplify it. And I think whatever the investment strategy is, whatever that portfolio is, there's really 2 components to it when you boil it down. One is the defensive component. How do we try to not lose money this year? And the other is that growth component. And one of the things that I like to think about, I like to dream a little bit, is, what if we had a solution that took care of defense at the end of the day? And then we could take the experts in the industry and pool all of their expertise, all of their knowledge, all of their creativity into focusing on offense. And how do we grow your money? And how do we build benefits that are meaningful, that can pivot with your retirement needs? And surprisingly, there are these solutions out there with indexed annuities that SILAC does. SILAC takes care of the defensive part of it. With an indexed annuity, the insurance company is saying, we've got you. We've got your back. We're going to protect your principal. The only way that your account value will ever decline is if you choose to do something where you're paying a fee for it, or if you take money out. Black and white, simple as that. And then we can pool all of our energy, that expertise, into coming up with new offensive new solutions for offense on how do we grow your money at the end of the day. For me, I always vote to be a specialist any day. I'd rather do a few things well as opposed to being a jack of all trade and doing a bunch of things fine. And that's what an FIA brings us. That insurance company's got it covered, and we have the freedom to come up with really innovative solutions at the end of the day to help clients earn interest credits every year. And that's what we're trying to do, is credit interest.
I mean, sort of tying Mark and Carrie's comments together, Nasdaq has been making a huge push into the insurance space, and we've certainly all benefited from that. On this table, we have a joint product that's out. So out of the 8 billion that Carrie mentioned, one of them is in a Nasdaq salt-powered index, and we're very proud of it because it actually outperformed last year. It was one of the top 10 performers in the space. So innovation is alive and well. I also want to add a couple of additional thoughts to the 60-40. I think, and this trend is continuing as well, alternatives. And an annuity would be considered an alternative, right? It's not your typical stock or bond that you add into a portfolio. And now that's becoming a much more popular, much more common thing than it was 5 years ago. And if you think about it, what's really driving it? It's demographics. I mean, if you think about the number of people who are retiring every day, and you look at the demographics of the U.S., 40+% are over 45 years old. And by the time we hit 2050, that's going to be 85 million people who need income, right? They need protection. So you're seeing continued product innovation for more fixed index annuities. Structured products are another solution, and again, in the distribution front, that's becoming more readily available to the average investor through different electronic platforms. And that is not slowing down. So for the next foreseeable decades, you're going to have demand for defensive products that protect your principal and offer you income.
Well, I mean, it makes sense. Look at the shock of 2022, right? I mean, that certainly proved that there's not a one-size-fits-all solution for all kinds of investors. I mean, we each have individual needs. So perhaps even the moniker 60-40 isn't the right thing because, to your point, annuities and other types of alts are really making up a big part of that ratio.
Yeah, and by the way, one thing that's really great about this industry is how efficient it is. I mean, if you take a look at the VIX right now, with all the stuff that's going on, it's below 13, which is incredible, right? It closed out December at 12, a level that it hasn't seen since 2019. And there's only been periods of spikes in 2023, and it was obviously the banking crisis in March, you know, Powell raising interest rates in May, and then the unfortunate attack on October 7th. So outside of those peaks, the market has been unbelievably calm, which is really good for returns. And as you've seen with the returns, you know, from the S&P and Nasdaq last year.
And I think people just react to volatility different ways. You know, we actually are seeing younger and younger clients purchasing annuities. We have several clients that are in their 30s that are purchasing it. I have the opportunity to meet with clients periodically, and one of the things that is fairly consistent in these meetings is I'll see maybe one of the couples is like, I want to be able to know that things are protected. I want to be able to sleep at night, and then we can have the freedom to use some of these other strategies as well. So it does seem like more and more clients are thinking about things a little bit more cohesively and just really wanting to be able to weather whatever storm. Because, I mean, I don't think a lot of people looking back at 23 would have expected a couple of wars going on and predicted those things. Things are changing quickly, and it's consistent that we're experiencing the unexpected at the end of the day. So we have to have very flexible solutions that can move with things that we can't predict at the end of the day. So.
And speaking of flexible solutions, let's talk about innovation in index design. I mean, to your point earlier, Carrie, you're saying, you know, there's hundreds of indexes available. So what does the future of this look like? Mark, we'll start with you. You know, how is it changing? How are you constantly thinking about, as an index creator, how are you thinking about innovation within the space?
Yeah, I mean, I think I want to go back a little bit to what Carrie said earlier in terms of dreaming of a new way of looking at how to meet investors' needs around managing, you know, their investment portfolios and their goals. And what we've seen the last couple of years, especially in our business, is that there's been a ton of product demand for sort of outcome-oriented indexes where, again, there's this idea around using a base exposure like the Nasdaq 100, which I think has earned its stripes as a major benchmark globally. And I identify a little bit, you know, we dream at Nasdaq of the Nasdaq 100 eventually becoming something that investors consider to be a core holding in their portfolio, like the S&P 500 is and has been, except, you know, more focused around where economic growth actually is happening in the 21st century in the US and globally, giving you more of that targeted exposure to the sectors that are really doing the heavy lifting and that have the potential to drive out performance over the long term, right? So that's my personal dream. But in terms of, you know, rethinking 60-40, I think 2022 showed us that, you know, if something cannot go on, you know, any longer than it has, it will stop and it will evolve into something new. And we've seen, you know, even with the rebound in equity prices in 2023, we've seen that the equity bond correlation has not gone back to what it used to be for the past 40 years, right? Because we were in a secular downtrend in terms of interest rates and bond prices, you know, going up for decades because of that long-term trend that in many minds I think has now broken. And so when you can't think about, you know, bonds rising when equities fall and offsetting each other and being negative correlated like they have been for the last, you know, several decades, that means you really do have to rethink things fundamentally. And again, we launched over 80 products last year in the Nasdaq index business. We're very proud of the pace of innovation that we're able to participate in. And a lot of that is, whether it's Nasdaq 100 related or not, again, listening to what clients want, listening to what their investors want, and that is delivering these more custom, outcome-oriented solutions.
Right, that's a great point that you made too about 2022. These things just don't go one way, you know, up forever. But when things not get broken, I don't want to use that term, but that also lends to the next phase of what truly is innovative. We've seen it happen in, I mean, we've certainly seen it happen in technology through a number of eras over the years. Many of them Nasdaq 100 companies, so it does lend to creating those new innovative products as you think about different scenarios clients face.
Well, I also don't think it's a coincidence that you need a year like 2022 to wake people from their traditional thinking and start getting a little bit creative and do a little bit more soul searching about what does my portfolio really look like? What do I really want to achieve with it? And again, going back to the demographics, people are looking for protection, and the wrappers that are out there, whether it's a buffer ETF, a structured product, a fixed index annuity, are offering that defensive protection that a lot of investors, still have the hangover from 2022, don't want to experience that again.
Right.
So.
And of course, there's also the changing roles of asset managers and banks and of course, technology providers. As clients are evolving, to your point, you have to listen to what clients want and what is that next solution for them. So industry roles are evolving as well.
Yeah, I mean, I think this partnership that we have right here is the perfect testament, especially to a year like 22. We can't all do this on our own. At this table, we came together, we built a great solution, but everyone brought their own expertise to it, and that design evolved through the course of that project to make sure that certain components were added to keep it flexible. So I mean, I think that these kind of power partnerships, as we think about innovation, how these solutions are going to change over time, they're key. But we also all have a responsibility to make sure that we're bringing that expertise, bringing it together in an efficient way. Because we could wake up, kind of coming back to the beginning, we could wake up where we have multiple people at the table and fees have gone up, and all of a sudden those fees can start dragging things down. And at the end of the day, it's not about any of us here. I'm going to come back to, it's about crediting interest to that policyholder at the end of the day, to that final consumer. And if we can come up with solutions to do that in various economic environments that we cannot predict, then that is successful at the end of the day.
The best of breed approach is definitely almost like the new norm in the industry, where you are bringing in unique expertise to fill very specific roles to deliver a very differentiated product at the end of the day. And that's what sells. And I think Carrie mentioned earlier, $70 billion in FIA premiums last year, record. It's continuing that pace in the first quarter. So there's overwhelming demand for these types of products.
Yeah, and it certainly is encouraging to hear. And Mark, as we go into our last 30 seconds here, any closing thoughts that you have?
I would just say that, we get to do a lot of interesting things at Nasdaq in terms of how our business, our index business, is positioned on the strength of our brand. It opens a lot of doors for us, and we're always appreciative to have fantastic partners like SILAC, like SALT, working with us to kind of leverage our experience, our knowledge of the market, to really continue innovating, right? Nasdaq at its core, I think, has staked its brand value on being a place where innovation happens day in and day out, including with all the companies that list with us. And so we're very excited to see where this industry goes specifically with some of these fixed index annuity products over the next decade. Yeah.
Right. We appreciate everyone's insight. Thanks for joining us on Trade Talks.
And
thanks for joining me from the MarketSite studio. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.